We're watching the same old shenanigans, right? Gold gets painted with a double top, and now it goes down $100 in 2 days as everybody sees the double top and says, I got to get out. I'm good for a while. Silver runs up. They paint a reversal candle, false breakout above 30 is what they're trying to do. They hike margins to pull this off. All of it, it's just crap. Because at the end of the day, and we've been talking about this for 15 years, without the physical metal, that whole system blows up. That's why you don't want it in an unallocated. You don't want your gold and silver in an unallocated account. You don't want it in ETF. You've got to actually buy it and own it and take delivery. And one day, and maybe it's beginning to shift, the physical market begins to actually assume pricing control.
Welcome to Economy Express, where we bring you the latest market insights with clarity and precision. Today, we dive into a crucial development in the precious metals sector. Could silver be on the brink of a short squeeze, pushing prices into parabolic territory? And what does this mean for gold? Market analyst Craig Hemke provides compelling insights that every investor needs to hear. Stay tuned as we uncover the forces at play and how they could shape the future of your portfolio. A familiar pattern: gold and silver manipulation.
That day with the silver squeeze back on February the 1st of 2021, I think silver got to 30.20, was a high. And then we had the famous, Rostam Benham, the head of the CFTC, talking about how we had to tamp down the price. Why? What business is that of yours? But again, when the big market-making banks are net short, like right now, 400 million ounces, well, every dollar that it goes up is another $400 million in paper losses. Not all constant, it's not all in one position. I'm talking net of a group. But nonetheless, another $5, that's $2 billion in losses. So to keep the market orderly, we got to tamp it down. You can see this then. This is why potentially Friday the 17th was such a big deal. Because after the run-up with COVID, in the spring of 2020, silver went up to 28.29. And then it was, again, inclusive of that silver squeeze, in early February 2021, 29 was like a hard cap. There were 4 occasions between July of 2020 and July of 2021 where the spot price of silver closed above 29. And on all 4, I invite anybody to go look this up. I'm not just making this stuff up. On all 4 of those days, the very next day, a huge red candle and a drop of about $1. Okay, so somebody knew, look, we cannot afford a breakout. All right. So fast forward to, really the week of the 13th. And all of a sudden, silver is just beginning to soar. It gets through 29, goes up to 30, gets through 30. And on the final day, Friday the 17th, boom, just blast forward. It looks almost as if pricing control is moving to Shanghai, because Shanghai is going up 5, 6, 8% a day and is trading at $35 an ounce. And COMEX is down here at 29. Well, at some point, do the banks have to let price go? Because if that arbitrage gets too wide, they're going to, the COMEX vaults, even if you count it all up and assume it's all there, is only 270 or 80 million ounces. Well, that can get drained pretty quickly if the arbitrage becomes profitable enough. So they have to let the price go up, right? I mean, there was maybe a reason why the heads of the 4 major bullion banks all appeared in Shanghai to meet with the Shanghai Gold Exchange people in late March and April. But maybe they're worried about this. Anyway, so you get this pop up through 30. We finished Friday the 17th at 31 and a quarter. It's a clear breakout. Actually, by the time the Globex trading ended at 5 o'clock Eastern that day, we were 31.77. It's a clear breakout. And again, at that point, price management mode kicks in, and that's now what we've seen the following week. Again, going forward, the key thing will be, Patrick, to what extent does a physical offtake market, within China, begin to now drive price? And does the COMEX have to become reactionary to that rather than proactive with their margin hikes and all the other crap games that they've played for decades?
For seasoned investors, the current fluctuations in gold and silver may feel like déjà vu. According to Hemke, the same market manipulation tactics that have been deployed for years are once again at work. Let's start with gold. Recently, we saw a clear example of how the price is being managed. A so-called double top formation emerged, a chart pattern that signals a peak and subsequent decline. Almost on cue, gold prices plummeted by $100 in just 2 days. Why?
There was a talk when copper was rolling up through $5 a pound last week, that suddenly, the COMEX, major short squeeze and all this. And maybe there was for a day, but really the pricing power in copper's in London on the LME, where it's priced by the ton. Okay. And that's an actual physical offtake. COMEX has like 20,000 metric tons in 6 different vaults geographically around the country, around the US. 20,000 tons is, believe me, it's nothing. I mean, it's next to nothing. So this idea that they were going to sail ships, divert ships full of copper concentrate and copper stuff to these COMEX vaults is just not written by people that don't know what they're talking about. But copper has more in common with silver now than silver has with gold. I mean, maybe one day again, silver will be a monetary metal. There's an investment component. I've got physical silver that I own as an investment that you don't really have with copper. But in terms of industrial and electrical demand, silver now has more in common with copper than it has with gold. And I mean, it's a great conductor of electricity. And so that is why, besides a little bit of investment demand, the total combined silver supply deficit from 2001 through 2024 is going to be like 700 million ounces. Okay. Now there's people that pretend to be experts that say, oh, well, that's because there's all kinds of silver laying around. It's not a problem. You can always melt down grandma's teacups, or place settings and her candlesticks. Okay. But the problem here is silver, again, is in short physical supply in a market that's, in the primary pricing scheme is off of derivatives and leverage. So what happens when the silver runs out? I'm going to can I just keep going for a second? I don't mean to.
No. Go ahead. Go ahead.
Like filibuster this whole thing. Okay. Let's talk. I want to talk. I've wanted all week to talk about copper, so I'm finally going to be able to do it. I have believed for 15 years that the supply of physical metal, gold and silver, is kind of just in time, hand to mouth, if you will. The banks that operate in London, remember Nowak, the guy from JP Morgan that's now currently in jail for price manipulation? He was the head of the JP Morgan Global Precious Metals desk, running paper price, but he was also on the board of the LBMA in London. Okay? So think about that as like a hand and glove. Okay?
Welcome to Economy Express, your go-to destination for all things economics and finance. Whether you're an experienced investor, an inquisitive student, or just someone who wants to stay ahead in today's ever-changing economic landscape, you've come to the right place. Now, let's get into the details of our news.
Because once traders see a double top, many decide to sell, triggering a domino effect that drives prices lower. Silver, too, has seen its share of these artificial price controls. Recently, as silver attempted to break above the critical $30 per ounce level, a reversal candle appeared, an indicator meant to shake out investors and convince them that the rally was over. At the same time, margin requirements were increased, making it more expensive for traders to maintain their positions. According to Hemke, these tactics are not accidental. They are calculated moves designed to suppress prices and protect the interests of major financial players. Who's behind the market manipulation? Hemke points to some of the biggest names in finance: JP Morgan, Citigroup, and HSBC. These institutions hold enormous short positions in silver, totaling 400 million ounces. Every dollar that silver rises translates into massive paper losses for these banks, about $400 million per dollar increase. A mere $5 rise in silver's price could mean a staggering $2 billion in losses. To avoid such losses, These banks employ a range of strategies, from adjusting trading hours to tweaking margin requirements. Even regulatory bodies like the Commodity Futures Trading Commission, CFTC, have historically intervened to tamp down silver prices, as we saw during the infamous silver squeeze of 2021. The big question now is whether these tactics will continue to work, or if silver's growing physical demand will eventually take control of price discovery. A shift in power. Is Shanghai taking over price control? For years, Western exchanges like COMEX have dominated gold and silver pricing. However, Hemke suggests that this might be changing. Silver prices in Shanghai have been soaring, reaching as high as $35 per ounce, while COMEX prices remain artificially constrained around $29 to $30. This discrepancy is significant. If the gap widens too much, traders could start arbitraging the difference, leading to a rapid depletion of physical silver from COMEX vaults. Just how tight is the supply? The total reported silver stock in COMEX vaults is estimated at only 270 to 280 million ounces. If physical demand continues to surge, banks may have no choice but to let silver prices rise, simply to prevent their inventories from being completely drained. Interestingly, Hemke notes that in March and April, the heads of 4 major bullion banks were seen meeting with the Shanghai Gold Exchange. Could they be discussing a new pricing paradigm? Commerzbank's precious metals forecast. What's next for gold and silver? Meanwhile, Commerzbank has updated its precious metals outlook for 2024 and beyond. The bank now expects silver to reach $30 per ounce by the end of 2024, up from their previous projection of $29. Looking further ahead, silver is now expected to hit $32 per ounce by the end of 2025, reflecting growing industrial and investment demand. Gold, on the other hand, is expected to move in the opposite direction. Commerzbank predicts that gold prices will decline to around $2,300 per ounce in the second half of 2024. This forecast raises important questions. Will gold's decline be temporary, or is it a sign of shifting investor sentiment? Silver's supply deficit. A ticking time bomb? Beyond price manipulation, there's a bigger problem looming: silver's dwindling physical supply. Over the past 2 decades, global silver production has failed to keep up with demand. Between 2001 and 2024, the cumulative supply deficit has reached a staggering 700 million ounces. This has profound implications, as silver is not only an investment asset, but also a critical industrial metal used in electronics, solar panels, and medical applications. Hemke draws a striking comparison between silver and copper. The copper market has recently faced significant shortages due to mine closures and geopolitical restrictions. Could silver be next? If so, a surge in prices could be inevitable, as supply constraints force the market to adjust. The big picture: a silver revolution in the making? With Shanghai emerging as a dominant force, COMEX inventories under pressure, and physical silver supplies tightening, are we witnessing the beginning of a silver price explosion? Hemke believes that if banks can no longer suppress the price through paper contracts, silver could experience a historic breakout. For investors, the key takeaway is clear: owning physical silver and gold, not ETFs or unallocated accounts, may be the best way to navigate these uncertain times. What do you think? Are we on the verge of a silver revolution? Drop your thoughts in the comments and stay tuned for more updates on the evolving precious metals market. This has been Economy Express, bringing you the insights you need to stay ahead of the markets. Don't forget to like, subscribe, and hit that notification bell for more in-depth financial analysis. Until next time, stay informed, stay invested,